everyone, this is Lauren Mack with Hacking the Rat Race. If you've been out shopping for groceries, gas for your car, or other products recently, you may have noticed that things have gotten a lot more expensive lately. And this is due to inflation, and it's at an all-time high. So today, we're going to talk about inflation. What is inflation? What causes inflation? And how much does the Fed's recent decision to raise interest rates to combat inflation affect you? So let's jump right in. What is inflation? Simply put, inflation is the rising prices of products and services in the economy. When prices go up, each dollar has less purchasing power. So essentially, one can buy less products and services with each dollar, resulting in a decrease of purchasing power. The loss of purchasing power affects the cost of living for all of us, which in the end leads to a slowdown in economic growth. Many economists believe that sustained inflation occurs when the nation's money supply growth surpasses the growth of the economy. Sometimes, a certain amount of inflation can be viewed as good for the economy, especially if it's working to boost consumer demand, drive economic growth, or keep deflation in check. In fact, most years, inflation is around 1 to 2%. So what's causing such high inflation in the economy right now? Well, there are many reasons. Some of these include supply chain disruptions as a result of the pandemic, increases in production costs, and growing consumer demand. I am sure you have noticed these skyrocketing gas prices. In March of 2022, Federal Reserve Chair Jerome Powell said in his semi-annual testimony in front of the U.S. Senate Banking Committee, as a rule of thumb, every $10 per barrel increase in the price of crude oil raises inflation by 0.2% and sets back economic growth 0.1%. You can look at the graph here of crude oil just over the last 3 months. Basically, from the beginning of the year to see how much prices have increased. This is just one of the many commodities that are skyrocketing. Another big reason is the increase in money supply. The federal government printed large amounts of money to pay for the pandemic relief programs, such as the $1.9 trillion American Rescue Plan Act of 2021. Remember, an increase in money supply reduces consumer purchasing power. According to the U.S. Bureau of Labor and Statistics, the Consumer Price Index for all urban consumers, the CPIU, was up by 7.5% in the 12-month period ending January 2022, the largest 12-month increase since the period ending June of 1982. In order to combat inflation, the Fed recently announced a 0.25% hike in interest rates in hopes of shrinking consumer demand. This is the first interest rate hike since 2018. The Feds have indicated that this is just the first rate hike that they have planned for this year. The effects of rising interest rates can impact consumers in many ways. You might find that you are directly impacted by the Fed's decision to raise interest rates. So let's talk a little bit about what interest rates are and how they affect consumers and their spending habits. Interest rates are essentially the interest rate that banks charge to lend money to other banks. This rate affects everything from your interest rate on your car loan, your mortgage, credit card debt, interest rates the bank give you for your savings account, and many other areas of your life. Since this could have a big impact on your purchasing power and savings, let's talk about a few of the things and what you can do to either capitalize off the rising interest rate and what you can do to keep from losing money. First, let's talk about car loans. If you tried buying a new or used car lately, you've probably been pretty surprised by how much cars cost right now. Due to supply chain issues, new cars cost more than they ever have. Many people have been surprised that when they go to purchase a new car, the manufacturer is unable to acquire all the parts necessary to assemble a vehicle, and the buyer has to wait months to get their car delivered. Well, what about used cars? Well, due to supply chain shortages of new cars, used cars are also selling at all-time highs. And to make matters worse, used cars are in short supply as well. If you're planning to get a loan for either a new or used automobile right now, the interest rate you'll pay for that loan will most likely be going up. That means you could be paying even more for that new or used car. In fact, Most other loans, such as personal loans and student loans, will most likely become more expensive as well. Well, what about credit cards? Most credit cards charge a variable interest rate on purchases. Credit card companies will most likely raise their rates, causing revolving credit to become more expensive. The best thing you can do to protect yourself from this is to try and pay off as much of your credit card debt as possible, because the Fed has expressed an interest in raising rates multiple times throughout the year. A way to pay them off faster and minimize the impact of rising interest rates would be to do a balance transfer to a card with a 0% interest for 12 to 18 months and try and pay it off as soon as possible. Another great option is to consolidate your credit card debt into a personal loan. The benefits of this is that personal loans have much lower interest rates, generally more favorable terms, and lastly, it can bring your credit utilization down on your credit cards, which can increase your credit score, sometimes as much as 100 points. A better credit score can result in lower interest rates on future loans, or even things like insurance premiums, which saves you even more money. So it can be win-win-win. One thing you want to be aware of, if you get a personal loan, is to find a personal loan without origination fees. Origination fees sometimes can be as much as 1 to 8%. You don't want to pay more money to pay off your money. If you don't know which personal loan companies don't have origination fees, I have another video called 5 Personal Loan Companies, No Origination Fees. I'll link to it above and in the show notes below. So, how will rising interest rates affect real estate? Well, expect mortgage interest rates to increase, which means it could be more expensive to borrow money to purchase a home. Higher interest rates may mean that you're not able to qualify for as much money as before, which could mean you have to settle for a smaller home. Housing prices are already at record highs in many parts of the US due to a rising demand and also an increase in raw materials and commodities such as wood. Fortunately, housing tends to be influenced by local factors, which means they're affected more by different forces within their location, such as desirability of the location, job opportunities, crime rates, schools, property taxes, you get the idea. Not solely on interest rates. Interest rates may have an impact on the stock market. There's always potential for stocks to go down because now it will be more expensive for companies to borrow money to grow their business, which can slow down the economy. Businesses may have to begin to cut costs and take other measures that may impact their bottom line and ability to grow for the short term. If this happens, then it's possible for the stock market to decline. However, just like real estate, rising interest rates do not always correlate with a decline in the stock market. It may go up or down because the stock market's influenced by many different factors. Bonds are very sensitive to interest rates. When the Feds increase the rates, the prices of existing bonds immediately begin to go down. That's because new bonds will soon be entering the market and will be able to offer investors higher interest rate payments. As a result of the higher overall rates, existing bonds will go down in price to make their lower interest rate payments more appealing to investors. One positive outcome for consumers is that the interest rate on your savings account should increase, which means that banks will give you a little more money for the money you're keeping in the bank. Now, don't get too excited though. Banks already give very low interest rates, and the institutional banks like Bank of America, Chase, and others will probably only raise their rates slightly. However, some of the online banks might raise their rates quite a bit more, so you might get a better return on some of these. An example of a good online bank that tries to be competitive with their interest rate is Ally Bank. Credit unions generally have much higher interest rates than institutional banks as well. I use a combination of credit unions and online banks just depending on the rates offered. Recent events with regards to the war in Ukraine could have an impact on the Fed's timetable for further interest rate hikes. Due to the global impact this has had on supply chains and the global economy, the Feds might not need to keep raising interest rates if the war drags on longer and the economy slows down as a result. Only time will tell. The best thing to do in times like this is to pay off your debt as soon as possible, so you're paying the lowest rate, and then start investing that money once your debts are paid off. If you're interested in consolidating to a personal loan that does not have origination fees, like I mentioned before, then check out this video right here.